Picture this. It's 2006, and Spain looks unstoppable. The Spanish economy has been on an absolute tear since 2000, with income per person more than doubling across just 6 years. Economists in Germany are projecting that within half a decade, Spain will surpass German living standards and emerge as a dominant European force. Employment in certain Spanish regions has effectively hit 100%, and the government keeps passing legislation to make jobs more comfortable and lucrative. The expansion was driven by widespread confidence in Spain's trajectory, and everyone wanted exposure. Eurozone membership opened the floodgates to international capital in a shared currency, and the smartest way to capture Spanish growth was to buy Spanish property. Purchasing a coastal villa in Marbella or an apartment in Madrid wasn't indulgent. It was shrewd wealth management that happened to come with Mediterranean sunshine. Estate agents were closing so many deals they achieved local celebrity status, and construction workers were in such demand that plumbers routinely drove luxury vehicles. Capital flooded in and households borrowed to increase real estate exposure, which drove construction activity, which made GDP figures spectacular, which made the country appear even more attractive to investors. The whole thing was unsustainable, and the twin shocks of the global financial crisis and Eurozone crisis ended the debt-fueled party abruptly. It wasn't until 2017, a full decade later, that Spain's economy exceeded pre-crisis output, and the recovery has been uneven at best. Joblessness stays elevated, particularly among young people. Broader economic activity has stalled, sovereign debt remains problematic, and perhaps most frustrating, the housing correction that triggered everything didn't even make homes affordable for ordinary Spaniards. Spain represents one of the most alarming economies globally because when you examine the speculative excess of the early 2000s, it's tempting to dismiss it as doomed with hindsight. Yet Spain's leverage ratios back then were actually lower than several major economies carry today. If Spain serves as a warning, we should probably ask whether we've absorbed the lesson. So what powered Spain's explosive growth? What triggered the collapse? Why has recovery been so elusive? And which major economies today are actually more vulnerable than Spain was in 2007? Before we dive into Spain's economic trajectory from spectacular growth to sudden reversal, if you want to understand the economic forces that drive global markets and policy decisions, subscribe to the Econaut. We break down the economics behind the headlines. Now, examining Spain's boom and bust highlights the critical importance of prudent wealth management. Spanish economic history contains numerous boom-bust cycles, from colonial-era gold mismanagement to Marshall Plan exclusion to premature liberalization. But to understand the current predicament, we need to start with the 1990s. At that point, Spain struggled with persistently high unemployment that simply wouldn't budge. The Spanish government joined the European Economic Community in 1986, hoping for economic advantages. That membership disappointed initially, as Spanish GDP per capita lingered around 72% of the EEC average. But after weathering an early 1990s global recession, the government controlled inflation and managed budgets sufficiently to begin reducing unemployment by mid-decade. The EEC integrated into the newly formed European Union in 1993, positioning Spain as an early Euro adopter in 1999. When economies remain independent, they retain complete monetary sovereignty. They can devalue currency to stimulate exports or manipulate interest rates to manage inflation and debt. But economic integration offers considerable benefits too. Sharing a currency simplifies cross-border commerce and typically proves stronger than individual alternatives. The euro meant access to deeper capital markets and substantially cheaper credit, which, depending on management, can shift from benefit to liability. Most economists identify 1998, just 1 year before euro adoption, as the dramatic turning point. Anticipating an immigration surge that materialized that same year, Spain became intensely focused on housing markets. With waves of new arrivals seeking citizenship, emphasis on residential construction intensified across every major Spanish city and coastal region. The Spanish government viewed construction as an economic silver bullet. It demands significant labor, could solve unemployment, boost GDP, and drive regional development. At the construction boom's peak, blue-collar tradespeople drove premium automobiles because their services commanded premium prices. Electricians, plumbers, and masons were earning more than lawyers and doctors in some regions. Inexpensive credit transformed everything. Spanish banks offered low interest rates. The euro eliminated foreign exchange risk, and property markets became gold mines for investors. Spanish government policy favored real estate with extraordinary tax incentives that few other European nations matched. There was no taxation on imputed rental value, essentially untaxed capital gains, mortgage interest deductibility, and what truly differentiated Spain, principal payments were also deductible from personal income tax. All this caused Spanish real estate borrowing to reach staggering levels. So why didn't Spain's central government recognize the warning signs? First, hindsight provides clarity that real-time analysis cannot match, especially when everyone around you is making money. But Spain's unique governmental structure also concealed the growing bubble. Fiscal decentralization meant Spain's central government played minimal roles in borrowing, unlike other EU countries. Internationally, Spain's debt appeared remarkably low because economic metrics examine only central government figures, completely ignoring provincial authorities where most borrowing actually occurred. The nation comprises 17 autonomous regions, each maintaining substantial independence in economic policy, taxation, and borrowing. Before 2008, approximately 45 different regional savings banks called cajas operated throughout the country, each independently making lending decisions. Most invested heavily in real estate, viewing property development as safe and profitable. This allowed Spain to report budget surpluses during boom times while regional and private debt was exploding. EU membership reduced barriers to European investment, so capital from Germany, the UK, and France poured in. Aggressive construction expansion made economic performance look exceptional, which attracted more investment, which made performance appear even better. At peak activity, over 12.5% of Spain's workforce participated in construction. The entire economy had become dangerously dependent on one sector. Spain alone generated over half the European Union's new employment, building more residences than Germany, France, and the UK combined despite having a much smaller population. Credit exploded and house prices surged 71% across just 5 years between 2003 and 2008. Spain did anticipate potential problems. After Eurozone entry, Spain's central government maintained teams collaborating with banks to reserve capital for potential non-performing loans, a precautionary measure virtually no other Western country implemented. They reserved approximately 35 billion euros, but it proved woefully insufficient. When the crisis hit, 35 billion euros disappeared almost immediately and represented perhaps 10% of actual losses. So what were the fundamental issues? Immigration was a primary initial driver, but projections proved wildly inaccurate. By 2006, the country had constructed over 800,000 homes to house approximately 200,000 families. 4 homes built for every household that actually needed one. Entire ghost developments sat empty along Spanish coasts. Some participants didn't bother changing regulations. They simply fabricated information. Professors Jose Maria Rey and Jose Garcia Maltova studied Spanish mortgage mechanics and uncovered systematic fraud. They examined loan-to-value ratios, or LTV, the relationship between mortgage amounts and property values. The Bank of Spain estimated that LTVs at or below 80% represented sound mortgages. But as LTVs approached 100%, risk increased dramatically. If banks faced mortgages with LTVs exceeding 80%, Bank of Spain approval was unlikely. Banks issued mortgages violating policy systematically. If financial workers noticed families with LTVs approaching 100%, they'd contact appraisal companies and modify property prices to reduce reported LTVs. Appraisal companies inflated property values so banks could issue mortgages that appeared safe on paper. Buyers could acquire homes they couldn't afford, and regulators remained oblivious. The system worked because appraisal companies earned fees from banks. With 80% of Spain's population as homeowners, this felt like paradise. Everyone was getting rich, employment was high, and the future looked bright. Until the bubble ruptured. When housing markets imploded, Spanish real estate debt equaled nearly 50% of national GDP. Thousands of families couldn't service massive debts, and with properties in negative equity, banks had no recovery mechanisms. Credit evaporated immediately, leaving speculative developers with massive non-performing loan portfolios. Construction companies went bankrupt overnight. This appears absurd with hindsight, but numerous countries today occupy arguably worse positions while similarly assuming immunity. For example, my home country, Australia, now carries household debt around 113% of GDP as of 2025, significantly higher than Spain's all-time peak of 85%. Australian household debt-to-income ratios have risen from the bottom half of advanced economy distributions in the late 1980s to the top quartile by 2018. There are identical warning signs: generous real estate investment tax policies, banks willing to overlook risks, migration-fueled speculation, and self-assurance that nice beaches justify homes costing 15 times national income. Then there's Canada. As of 2025, Canada's household debt-to-GDP ratio sits around 100%, again exceeding Spain's historical peak despite recent moderation from pandemic highs. Spain's early 2000s house price increases now appear relatively conservative compared to price escalations these economies experienced over recent years. And while it would be pleasant to report Spain recovered nicely, they're still addressing crisis fallout nearly 2 decades later. Initially, Spain spent aggressively, more as GDP percentage on stimulus than any other European country. But then Greece stole the spotlight. In 2009, Greece's new government disclosed that fiscal deficits were far higher than previously understood, and markets lost confidence immediately. Greece became the new headline crisis, burying Spain's cautionary tale for nearly 2 decades. This didn't eliminate Spain's problems. While most Western nations took hits during 2008, Spain's system was particularly devastated because of extraordinary dependence on construction. Though they've seen growth since 2017's recovery, the lost decade meant nearly 10 years of zero real growth. When Spain flew high in the 1990s, annual salaries competed with France, Germany, and the UK. Now they stand far below most developed nations at €29,113 average annual income, approximately 9 to 11% less than pre-crash levels after adjusting for inflation. Average Spaniards are measurably worse off today than 2 decades ago. The nation was forced to restructure all but 2 of the 45 cages, making credit access harder even today. Euro ties remove much of Spain's ability to depreciate exchange rates to regain competitiveness. Countries with independent currencies can devalue to make exports cheaper, but Spain lacks this mechanism. Lower incomes created brain drain. Doctors, engineers, researchers left for Germany, UK, and elsewhere offering higher salaries. Unemployment remains higher than most European nations despite official statistics showing improvement. Many deemed employed are actually working small gigs with no long-term career prospects. Perhaps it's too late for Spain, and the country must rebuild slowly if at all. But for other countries, opportunities exist to change these patterns before reaching Spain's situation. With these common themes emerging in Australia, Canada, New Zealand, and others, it's time to recognize what Spain truly represents. It's more than just a country with struggling economics, astronomical youth unemployment, and ironically high housing costs despite a massive crash. It is, in every sense, a warning that should be heeded before it's too late. A warning that economies cannot solve fiscal problems with one sector assuming massive debt while expecting endless appreciation. A warning that excitement can eclipse rational judgment even among sophisticated investors and policymakers. A warning that if housing crashes like this can happen in Spain, a developed European nation with modern institutions, that can happen anywhere else. Fast money is exactly that. Fast money. And it can disappear just as quickly or faster than it arrived, leaving devastation lasting decades. Now Spain's neighbor Portugal experienced similar challenges, but they're attempting to rebuild their economy in a unique way that appears to be working but hasn't been particularly popular. You should be able to click to that video on your screen now. Thanks for watching, mate. Bye.